Hello everyone. My name is Mark Pearson. I'm the co-founder of Arcus Investment. We are a investment management company specializing in Japanese equity investment, and we started in 1998, so we're 25 years old. My whole life has been connected with Japan ever since I was at university. And this summarizes my career as a fund manager. I became a fund manager at the very peak of the Japanese market at the end of 1989. And I think in the last week or two, we've finally made a higher price than it was back in 1989. So we had the longest ever bear market. There may have been longer bear markets somewhere in the world, but I personally don't know of any. So we had 23 years for the market to go down 80%. And since Mr. Abe became Prime Minister for the second time in 2012, we started to see the market go up again. So this is our first fund, Arcus Value Fund, in January 1999. So just to show you from the beginning, we've aimed at being basically value investors. This is my colleague Peter Tasker, who was the face of our fund when it was launched in Japan. And I look back with fondness because the day before we started investing our first fund in January of 1999, Peter sent me this message, and he said, our investors hate topics. This is 1934, and you are Benjamin Graham. Just to drill the responsibility into me as the fund manager, that this was not going to be an easy ride. I'd just like to say a couple of things about Japan. It has been said, I don't know whether it was Churchill, but Japan is a riddle wrapped in mystery inside an enigma. Well, to me, Japan is my second home. It's sometimes my first home. Half my family is Japanese. So to me, I don't particularly find Japan enigmatic or a mystery at all. To me, it's a natural place to be, a very comfortable place to be, a very nice place. But also Japan does have some very different culture and customs, sometimes for the better, sometimes for the worst. But like a country like Spain or UK, it has its own unique culture, very tremendous, interesting and valued culture. But Japan has been through tremendous change during the last, 30, 40 years while I've been investing in Japan. So one of the important things for us as investors in the market is Japan has gone from the highest valuations in the world in the 1980s, PEs in the 70 to 80 to 90 times earnings, to one of the lowest. So until quite recently, Japan, the market was priced at 10 or 11 times PE and about 0.8, 0.9 times book. Well, the market has increased a little bit since then, but not very much. So even though the market has started to increase quite a lot since 2012, about 2 or 3 times, maybe 3 times or 4 times even since 2012, the market has not re-rated. The price to book remains pretty low in the range of 1 to 1.4, which is the last decade, and the PE is also similarly we've scarcely re-rated, even in the latest time in which the market's even up it's almost up 50% year on year. The other thing I'd like to emphasize is that the companies have changed almost immeasurably. I look at the Ministry of Finance data in Japan, and we can see from 1954 through to the 1990s, the Japanese corporate sector leveraged up until they had 300 trillion yen of net debt in the early 1990s. So that's about 60% of their GDP. But everything unraveled from the 1990s onward, and Japan realized it had too much debt, too much inefficiency, too much capital, too much waste. And the corporate sector got serious, and they started to repay that debt, and they started to rebuild their profitability. And as a result, they generated a lot of free cash flow. So now we have a corporate sector which has eliminated its net debt. In aggregate, it's got net cash currently of about 29 trillion. So one of the things that Japan is now criticized for is for having too much cash. And what are they going to do with the cash? Having improved their profits and margins and cash flows, what are they going to do with that cash? So obviously that's one of the main subjects we get asked about nowadays, the improved corporate governance, more dividends, more share buybacks, and so on. Just quickly on our fund. So this is our main fund. It's a UCITS fund. Have quite a strong performance since inception. We run 3 strategies. We run a large cap long only strategy, a small cap long only strategy, and a long short strategy. And these strategies pretty much we've run since the beginning. Our first fund was Arcus Japan Fund. This is our large cap equity strategy. We began with the domestic Japanese money because we started managing, first of all, for our first about 5 years, we only managed Japanese equities for Japanese institutions and Japanese retail investors. Now, we don't have any Japanese investors, and we have mostly European investors. So this is our large cap equity strategy, up 7 times in 23 years. And the small cap strategy, following on from that first fund, is up 15 times in 25 years. I won't spend too much time on that because we've been asked to spend most of our time today on a stock idea, a stock that we invest in. And I've chosen this company called IHI Corporation. And it's called IHI because it's a bit too much of a mouthful to say, Ishikawa Jima Harima Ju Kogyo. So let's stick to IHI. And after I'd chosen this stock, I'm quite pleased I've chosen this stock because I actually started to look a little bit more into the history of IHI. It was founded in 1853, so it is quite an old company. And why it was founded in 1853, it's because the American Commodore Perry arrived on the shore of Japan in 1852 in order to force Japan to end its 220-year period of entire closure of the country. So the Americans wanted to bully Japan into opening up trade links. And so Japan immediately realized, Commodore Perry came with his gunships and hung around off the coast of the Miura Peninsula south of Tokyo and threatened to bombard Japan. So Japan said, well, we don't really want this, but if they're going to push us, we'll have to deal with it somehow. So in 1853, the next year, they commissioned a shipyard to be built to manufacture warships and cannons so that Japan could defend itself. And IHI is the company that originated there. Now, for better or worse, IHI no longer makes warships, but they have developed into one of Japan's leading engineering companies. And I will show you the, I thought, actually I should have stopped on that slide, because this takes us back to 1853 and a bridge over a river in Japan. And it's a tenuous connection, but IHI also makes bridges. And this is the horrific sector breakdown of IHI's business. There are 4 major divisions. So we have aerospace and defense, we have resources and energy, we have industrial systems and machinery, and we have social infrastructure. And as you can see, each division is made up of several items. And in fact, the biggest single business is civil aero engines, which is 15%, and then you've got other, that's 12%, and you've got carbon solutions at 12%. So it's kind of difficult to work out what's going on. I think that's part of the problem for IHI. They do too many things. It's confusing. It's very difficult to work out what they are. and it's almost impossible to identify how much money they make on each little part of the different divisions. But let's have a stab at it, and I think I'd like to focus on two areas because they are more the swing factors in the business. And the first one is the biggest business, which is aerospace. And what IHI has been able to do is become one of the world's leading manufacturers of turbines and turbine blades. And turbines are used in many different applications. But obviously, aerospace, aircraft engines is an important one. So here are the engines that they make. This map shows the evolution of the different types of engines, and we can see that the aerospace engines are moving into second generation aerospace engines, which are more efficient, quieter. I suppose we all notice our aeroplanes are getting quieter when we're flying these days, quieter and more efficient. And we can see that the overall growth of the aerospace engine market has been around 3%, as IHI helpfully point out. But also they are gradually increasing their share. So we can see that as we move from the first generation to the second generation, IHI are claiming that they have higher market shares. So the other very important point about aerospace engines is it's a money-losing business. Now that's a bit of a problem for a manufacturer. And so here's an article from last November from the British Sunday Times where they talk about Rolls-Royce and the new owner of or the new CEO of Rolls-Royce is saying we lose £1 million on each engine that we build. So how do they make money? Well, as he goes on to say, the real money comes from the long-term contracts to service those engines. Under the agreements, the longer they are in the air, the more money Rolls-Royce makes. So during the pandemic, when the planes were grounded, there was no revenue from spare parts or servicing, and so it was a nightmare for them, they say. Well, IHI is doing pretty much the same business, and IHI helpfully give us a chart to show the development of a new engine. First of all, there are immense costs in developing the engine, and then when you start selling it, you lose a lot of money, and so only eventually you start making money from the servicing and the parts. But you do make good money because I'll go into that in a second. But this shows that we have a steady increase in the number of aero engines delivered. So it's a favorable trend. But remember that every engine that they deliver represented an upfront loss, but will generate future profits. So in that installed base of 23,570 engines, they have a guaranteed long-term revenue and profit stream. And this shows the growth in the revenues of the engines and the aftermarket. It's pretty steady growth. Here we can see the history of the profitability in that division, the Aero Engine, Space and Defense. And as you might have anticipated, during 2020, during the lockdowns and the grounding of all the world's air fleets, they went into a loss. And so what we've started to see is the recovery of air travel, and so the division has returned to a 12% operating profit margin, which is not too bad and certainly better than IHI's average overall. But in last year, 2023, there was a major problem. You may have noticed that Pratt & Whitney announced that they had a fault on their engines in one of Pratt & Whitney's subsidiary, which makes powdered metals. There was a flaw in the product, and so all the engines which Pratt & Whitney had supplied to the world's airline companies have to be grounded. So this will happen over the next 3 years. And Pratt & Whitney, as they say here, this is Raytheon, which is the parent company of Pratt & Whitney, and they have to take a $3 to $3.5 billion provision, which represents their share of the losses. But unfortunately, IHI has a 15% share of that engine joint venture, whereas Raytheon Pratt & Whitney has a 50% share. But IHI has to take its share of those losses, even though it's not IHI's fault. So they had a bit of bad luck there, but it's definitely was taken as a very negative point, and it led to the share prices dropping sharply. And although Pratt & Whitney has recovered, IHI share price did not recover very much. Let's also, I think the second area I'd like to touch on in a little bit of detail is the Japan defense budget. Well, perhaps it's well known that Japan, after the Second World War, for decade after decade, had a cap of 1% of GDP spending on defense. Now, wouldn't it be wonderful if the whole world spent less than 1% of GDP on defense? However, unfortunately, we live in a world in which that is not sustainable, and Japan has been encouraged to increase its defense budget. This summarizes the 5-year budget, basically for Japan's defense. You can see the years there: 2005 to 9, 24. That means trillion. So in the successive 5-year plans, we have 24 trillion, 23.5 trillion, 24.7 trillion, 27.5 trillion. So pretty steady. But the new plan for 23 to 27, they've increased that budget to 43 trillion. So a huge increase. And we can also see that within the budget, the breakdown of equipment is going from 24.7%, equipment 15.8% there, up to 20.6%. So there's an increase in equipment. And also maintenance and so on is going up. So they're spending more on hardware. Well, this is the kind of thing that IHI makes. Things like, I think I showed you earlier, missile propulsion systems and turbines and engines for submarines and stuff like that. This shows the annual spending or budget for the for defense, and we can see that shooting up. And this one, I'm sorry, I haven't translated it, but basically, in those decades in which the Japan defense budget sort of was quite stable and stagnant, the Japanese defense contractors' guideline. Well, the guideline, we can see on the left-hand side, the guideline was 7.2% profit margin, but the reality was it was very difficult for them to make even 5%. However, in order to, and actually, one of the things was some companies in the defense business in Japan gave up. It's not worth, continuing to try to service this market, and we're scarcely able to make 5% profit margin. So the government recognized that they have to do something to make it worthwhile for the companies to bid. So the new budget proposal is that they will aim for a range. Basically add the numbers on the right. So it's a range of 6 to 15%. So it's very likely that companies, the government has accepted the need to allow companies to make a better profit when they're bidding. So probably profit margins which struggle to reach 5% will probably reach 10% or possibly more. And I showed you earlier the breakdown. So in the aerospace division for IHI, it said 15% is aerospace, aircraft engines, and 12% is other. Well, most of that other is defense. They just don't put it in their IR materials. It's probably at least 10%, and the other 2% is space rockets and so on. What they used to have, so 10% of their revenues would be about 135 billion yen, on which they could possibly make 5%, if that. 6 or 7 billion, maybe at best. But in the future, if their revenues double, which is quite plausible, the revenues could be 270 billion, on which they make 27 billion profit. So that would be, it's about 4 or 5 times the profit, and quite significant to their overall business, as we shall see. Now, how are we doing for time? I spent a couple more minutes on IHI. I will just say, the industrial systems and general purpose machinery, it's very broad. The biggest element of that is turbochargers. IHI is one of the world's leading makers and Japan's top maker of turbochargers. They sell globally to around the world. As we can see here, it was declining until 2021, since when it's bottomed out, and it'll probably grow steadily. It helps that the world is pulling back to some extent from the obsession with electric vehicles. And that was another reason why the share price of IHI got very depressed, because people thought, oh, they don't make turbochargers, and no one will ever use turbochargers once we're all driving electric cars. Resources, energy, and environment, it's mostly, they call it carbon solutions. It's actually, power plants. Again, we need power plants. They make also nuclear power plants and decommissioning. I'll just show you quite a dramatic chart, a dramatic picture here. This is the blue line represents the operating period of Japanese nuclear power stations. It all stops in 2011 when Japan has its tsunami. Yeah, and they have just begun to reopen some of the nuclear power plants. So Japan is still running very tight on its power generating capacity, and is likely to need further reopenings of the nuclear plants. So again, this is a business that's likely to recover and grow in the years ahead. We have social infrastructure, many things. They make bridges, water gates, transportation systems, shield systems. They're, in Japan does a lot of tunneling. IHI is the biggest and best maker of shield tunneling equipment. Japan is currently building a linear train which will go from Tokyo to Nagoya and then on to Kyoto and Osaka in a time just almost as fast as the aeroplane. So they do a lot of social infrastructure. It's a very steady business. But so most of the machinery and social infrastructure is quite stable. And this shows that Japan has been building bridges for a long time, and reminds us of Japan. I'll just touch briefly on IHI's real estate holdings, because when IHI was invited to make the first dock shipyard for warships in 1853, they were given this land, and this land is 9 minutes by taxi from Tokyo Station, and it's a very large piece of land which used to be shipyards, and IHI has been steadily redeveloping this land and turning it into valuable office properties. They give a helpful summary of the value of this property. They say the book value on the books, it's carried at 142 billion yen, but the fair value appraisal is 344 billion yen. So that's quite a handy backstop to have, given that the market cap of the company is about 520 billion. So if it's a useful thing to have for a rainy day. But the share price has been languishing. So this is 50 years of share price for IHI in the light brown at the bottom. It's done nothing, really, while the market's gone up quite nicely. On the whole, it has been growing shareholders' equity. The latest dip in the latest quarter, we can see there on the right, that's the write down from the Raytheon Pratt & Whitney accident. And net profit has been patchy. It's not surprising it's not a very popular company, but we see signs of improvement. I won't go into this one. It's the historical trend in operating income. It basically shows the major contributions. I may touch on it in a second. But one of the reasons why IHI is not liked as fairly out of favor in the Japanese market is they do have a history of accidents. So, the Pratt & Whitney wasn't their fault, but there have been several things which were their fault. So 2007, a small penalty for false reporting on projects. 2008, they lost 74 billion on a Saudi Arabia cement project. They then gave up foreign cement plant building. In 2016, they had a problem on this big Turkey suspension bridge where they had part of it collapsed. So it took 49 billion loss there. And in 2021, of course, again, sort of out of their control, but the COVID lockdowns and travel restrictions led them to take a 40 billion write down. So it's a mixture of bad luck, but also, especially in the earlier years, some bad project management. So I think that's part of the reason why it is priced at a fairly low level. So let's get on to that. First of all, let's just note the peer group on the engines. Here are some of the global peers in aerospace: Safran, General Electric, Rolls-Royce, and so on. IHI is on a PE of roughly 7, but their peers are traded at a PE of 19. And on EV to EBITDA, IHI is at 6.5 compared to the peers at 11. So I won't go into these, but let's just pull it all together and look at the possible profit that IHI should be able to generate. First of all, aerospace, at a minimum, I think they can reach, just go back to the 2016-2019 level. They've got a higher installed base. Their revenues are higher. They've got the new engines in the new generations coming through. I think they could easily make, 50 to 60 billion is not a stretch. On top of that, I have not factored in the potentially 20 odd billion additional profit which could come from the defense, or potentially higher revenues from the higher installed base on engines and a higher market share. In the industrial systems, resources and energy, social infrastructure, it's 15 to 20 billion each. Take out the usual adjustments, and I conservatively estimate a range of operating profit of 85 to 115 billion with some upside. So roughly 100 billion of operating profit translates to approximately 70 billion of net profit, and that gives you 7 times earnings. And for the upside, I think first of all there's profit upside in the forecasts. 7 times P is just cheap. I think a conservative estimate, a very plausible upside is 50% to 10 or 11 times earnings, even on no stretch. But on top of that, when aerospace and defense becomes a more powerful theme and more popular in the market, there's no reason not to expect a PE in the the low teens for IHI. Certainly been there in the past, and so I think that gives, for my part, I would say there's a reasonable prospect of 50% upside, and not a bad prospect of possibly doubling. So that's my
Thank you, Marcus.
discussion.
Any questions?
I'm happy to take any questions there.
Any question on this side? Thank you for the conference. I just wanted to ask, what is the balance position of the company?
The balance sheet.
In the sense of it has net cash. How big is it from the market cap, and if there is debt or any outside of the balance sheet obligations? Thank you very much.
Yes, thank you. Well, the company does provide for, the company has provided for its share of the Pratt & Whitney engine losses. So that's shown in the latest quarter I showed there, which is the dip in the shareholders' equity. The net debt is 70% of the market cap. So that translates to about 350 billion yen. And coincidentally, that is the value of the land holdings which it had. Now, as I say, in extremis, they could sell that land. It's good commercial property land. Half an hour walk from Tokyo's Central Station. It's very good. It's very good office property. So I think the market valuation which they have in their accounts of about 350 billion is conservative, and so I think the balance sheet is not stretched.
So I have a question here. Thanks, Mark. For that, there's a lot of detail in those slides. So if you don't mind, I sort of wanted to play back kind of what I think I heard, which was the core aerospace defense business, sort of pillar one of your story is the recovery in that and the potential for that to actually be a growth business, not just a cyclical business in time with catalysts and things happening. Then you've got some other areas that they've got into that could become future pillars, like the ammonia, clean energy side of things. That's an option for you. The bit I had a question on was what the third bit, which is like the rest, which is this kind of, we sell products and we sell services. It all seems a bit of a mess, but my understanding is they've tried to change that and what they call these life cycle value chain sort of approaches, and this wonderful phrase of Project Spiral, which I liked, the positive spiral initiative. Is that credible? Have they got the ability and management to go and sort of surround the customer value chain? And is that M&A needed? What is it to actually make that pillar work?
Yeah, that's an interesting question. Incidentally, I will be meeting the company next Wednesday for my next visit. It's a good question to ask. But being involved in, for example, social infrastructure in Japan, and of course the machinery side, all the turbines going into boilers, going into power stations, going into industrial turbine and energy generation. Of course, the IHI. It's not exactly a blue chip in Japan, but it's a light blue chip. It's a well-connected, very well-established company, well connected into the obviously with doing a lot of infrastructure, a lot of creating the infrastructure of the future. They're obviously also very well tied into government and government planning, technology development, roadmaps for the Japanese transportation system, major projects like the linear, the maglev which they're building. I think that can be taken for granted that they're well into that and well into the long-term planning and coordinating that long-term planning with their customers, which include the government. So I think the answer is yes. The answer is yes. That's where also they can get more value added by not just providing a shield tunneling machine, but also working with the construction companies in order to improve the efficiency of the operation. Companies like IHI and Japanese companies, they are strong in incorporating automation into construction machinery, equipment operation, and so on. So I think yeah, my answer is it's a natural part of what they do, and that is exactly what they are, you know, building systems around all their products and services. But I don't think we need to factor in any growth. I mean, you could say, you know, the Japanese infrastructure was quite heavily built up to the 1980s and 1990s. And then after about 1997, Japan changed a fairly lax fiscal stance to being rather tight, because Japan became notorious for overbuilding bridges and overbuilding roads to nowhere, that kind of idea. And after 1997, Japan introduced much more fiscal discipline, believe it or not, because I mean, they were getting much lower tax revenues due to the economic stagnation. So in the years since the 1990s, the Japanese infrastructure has not really been renewed satisfactorily. You know, Japan is a great place to visit and everything works, but the infrastructure is aging. There are a lot of old bridges in Japan which need to be replaced, as for example. So that will be a source of work for companies like IHI for decades to come. But I don't think we need to factor in any particular growth, nor do we need to factor in too much growth in these areas. I think there'll be steady. There'll be some growth. You know, green energy. Of course, the government, like in Japan, is following the green energy push to some extent, you know, to the extent that they have to, I think, and that will throw up opportunities for a company like IHI. I mean, they've got the technologies.
Thank you very much. Sorry, just a very quick question on management and shareholders, and any like alignment of interests, and also following the hiccups in the past. Have there been any changes in management? Like, what's the turnover of the CEOs?
Yeah, we have a new CEO from about a year or so ago. We've had a call with him. He has assured us of taking, well, essentially a business-like and commercial approach, and a recognition of the weaknesses of the past. And the need to improve. I wouldn't say it's any. I don't think that's. I think that is typical of Japan. Japan, given the long years of stagnation, reset the country and the business attitude from, you know, fairly hubristic sense to being much more modest. So what we get from Japanese companies in IR, for example, is we get very modest comments. We don't get companies overselling themselves, but they say, you know, we'll do our best. This is how we see things. It's extremely rare for a Japanese company to overpromise. Generally, it may come back again as things have started to improve. But on the whole, I have a great sort of realism and modesty and prudence, I feel. In terms of the shareholder, the shareholding of IHI is very broad. It has sort of diluted and dissipated over the 170 years since the company has existed. So they don't have. I mean, traditionally they had a kind of like a sister relationship with Toshiba, because Toshiba also grew out of being a torpedo manufacturer, but now it's an independently run company. So in terms of alignment, in Japan, on the whole, you don't get a huge amount of alignment. So presidents do own the shares, definitely, but it's not that they own, you know, $1 billion worth of shares. I mean, they might own or have interests in a few million dollars. But in Japan, companies and managements are expected to do their best, will not necessarily have to be hyper-incentivized to do it. They do it because it's their duty, and they accept that duty.
Okay.
I mean, they get well paid, and they get a nice house, and but it's not an extreme level of incentivization.
Okay, thank you very much. Thank you.
All right, thank you very much.
Bonsoir.